Hello everyone and welcome to the channel. Today we're diving into a hot topic that's caught the attention of investors worldwide. Gold prices have hit record highs. But what does this mean for investors and how can you take advantage of it? In this video, we'll explore why gold prices are soaring, what it could mean for you as an investor, and most importantly, how you can invest in gold, whether by buying it physically or through financial markets. If you're ready to learn more, be sure to like this video, subscribe, and hit the bell icon to stay updated on all my future content. Now, let's get into it. Let's start with why gold has reached these new all-time highs. Gold has long been considered a safe haven asset, a go-to investment when things start to get uncertain. But what's driving the recent price surge? 1. Global economic and geopolitical uncertainty. One of the main reasons is global economic uncertainty. Whenever there are signs of crisis, be it recession, political instability, or geopolitical tensions, gold tends to shine. This is because it's seen as a safe asset. When stocks or other investments get too volatile or risky, gold serves as a stable option for investors. Recently, a range of events has contributed to this uncertainty. Trade tensions between major economies like the US and China, regional conflicts, and rising tensions among global superpowers, not to mention the economic impact of the pandemic. All these factors have driven investors towards gold. 2. Rising inflation and expansionary monetary policies. Another factor driving gold's rise is inflation. With prices on the rise across various sectors, investors are looking for assets that can help protect their purchasing power. Gold, known as a store of value, is seen as a natural hedge against inflation. Central banks have implemented expansionary monetary policies, including quantitative easing and ultra-low interest rates, which have pumped liquidity into the markets. This has also raised concerns over currency devaluation, especially for the US dollar, pushing investors to look to gold for stability. 3. Weakness in global currencies. When major currencies weaken, gold, which is traded internationally in US dollars, becomes more expensive. Recently, the US dollar has faced some challenges due to economic uncertainties and growing national debt. This has further driven up gold prices as it's seen as a store of value that's independent of fiat currencies. 4. Increased demand from central banks and institutional investors. Another interesting factor is the growing demand for gold from central banks. Countries like Russia, China, and India have significantly increased their gold reserves. This is because gold represents a stable reserve that helps diversify their holdings and reduce reliance on the dollar or euro. Institutional investors, including pension funds, hedge funds, and large investment banks, have also increased their exposure to gold. They recognize its potential to protect portfolios during uncertain times, creating additional demand for the metal. So what does this mean for investors? Gold at all-time highs can be seen as both an opportunity and a potential pitfall, depending on your investment strategy. 1. Long-term growth potential. Despite gold reaching record highs, many analysts believe there's still room for further growth. If economic and geopolitical uncertainties persist, or if inflation continues to climb, gold could continue to rise. During periods of crisis like the one we're currently experiencing, gold has historically proven to be a resilient store of value. If you already have gold in your portfolio, this could be a favorable situation, as you're likely seeing the value of your investment increase. However, for those looking to invest now, it's important to consider whether now is the best time to enter or if it's better to wait. 2. Risks of buying at record highs. On the other hand, it's crucial to remember that buying any asset at record highs comes with risks. Gold, like any asset, is subject to price fluctuations. While long-term prospects may be strong, short-term corrections could occur, especially if the economic outlook improves or markets stabilize. Ask yourself, are you investing in gold as a hedge against global risks, or are you speculating on its price? Your answer will shape your investment approach. Now let's look at how to actually invest in gold. There are several ways, each with its own advantages and drawbacks, depending on your need for liquidity, security, and risk tolerance. 1. Physical gold, bars and coins. Buying physical gold, such as bars or coins, is the most traditional form of investment. With physical gold, you have the advantage of owning a tangible asset, which can give a sense of security. However, owning physical gold also comes with challenges. First, you need a secure way to store your gold. You can't simply leave it in a drawer at home. You'll need a safe deposit box or a private vault, which comes with storage and insurance costs. Physical gold is also less liquid than other forms of investment and can be harder to sell quickly, especially in large quantities. 2. Gold ETFs, exchange-traded funds. If you're looking for a more liquid and accessible way to invest in gold, gold ETFs are a popular choice. ETFs track the price of gold without you having to own the physical metal. They're easy to buy and sell on the stock exchange, just like shares, and allow you to gain exposure to gold prices without the hassles of storage. However, remember that ETFs come with management fees, though they're typically low, and they don't give you direct ownership of the gold. In extreme crises, some investors might prefer holding physical gold. 3. Mining company stocks. Another way to gain exposure to gold is by investing in mining companies. These companies benefit from rising gold prices since their revenue and profits increase with the price of the metal. However, investing in mining stocks is more speculative, as you're not only betting on gold prices, but also on the company's management, operations, and other business risks. Mining stocks are more volatile than gold itself, so it's essential to research and consider a company's management, mining efficiency, and geopolitical risks. 4. Gold certificates and futures. For more experienced investors willing to take on higher risks, there are gold certificates and futures. Gold certificates let you invest in gold without physically owning it, while futures contracts allow you to speculate on future gold prices. Futures offer the potential for large returns with relatively small capital through leverage, but also carry significant risk as losses can exceed your initial investment. 5. Digital gold and new platforms. In recent years, buying digital gold via online platforms has become more popular. With digital gold, you can buy small fractions of physical gold stored in secure vaults without needing to handle it physically. These platforms make buying, selling, and trading gold easy and accessible, offering a modern alternative to traditional gold investments. At this point, you're probably wondering, which method is best for me? As we've seen, each option has its own pros and cons, and the right choice depends on your risk profile, volatility tolerance, and liquidity needs. 1. If you're a conservative investor looking for long-term stability, physical gold might be your best choice. It's less liquid and comes with storage costs, but it provides a sense of security and independence from the financial system. 2. If you prefer a more straightforward and liquid way to invest in gold without worrying about physical storage, ETFs could be ideal. They're easy to trade and offer exposure to gold's price. 3. If you're willing to take on more risk for potential growth, consider mining stocks. Remember, though, that here you're not just betting on gold's price, but also on the company's management and mining operations. 4. If you're an experienced trader seeking speculative opportunities, futures could be a good fit, but they require a solid understanding of derivative markets and a high risk tolerance. 5. If you want the ease of digital management, consider digital gold platforms. These allow you to own fractions of physical gold easily with the benefits of digital flexibility. 6. Lastly, if gold is part of your culture or you prefer tangible assets with sentimental value, investing in gold jewelry might be an option. Just note that jewelry values may not reflect gold's actual market price due to craftsmanship costs. Before we wrap up, let's talk about some general strategies for investing in gold. 1. Portfolio diversification. Gold is commonly used as a tool for portfolio diversification. If you already have stocks, bonds, or real estate, gold can act as a hedge against market risk. Typically, holding around 5 to 10% of a portfolio in gold is a good rule for those seeking stability, though it depends on your goals and risk tolerance. 2. Insurance against crises. Another approach is to view gold not as a short-term profit generator, but as insurance against economic crises or high inflation. In this case, physical gold or a mix of physical and ETF gold could be ideal for protecting your wealth. 3. Short-term trading. For active traders, gold can be a tool for short-term speculation. Its volatility during crises can offer interesting opportunities for those willing to monitor markets closely and act quickly. Futures or leveraged ETFs may be worth considering in this case. 4. Dollar cost averaging, DCA. If you're concerned about buying gold at its peak price, consider dollar cost averaging. This strategy involves investing a fixed amount in gold at regular intervals, such as monthly or quarterly, regardless of its price. By spreading out your purchases, you can avoid the risk of buying all at a high point and average out your investment cost over time. DCA can be particularly effective during times of price volatility, giving you a more balanced entry point. In conclusion, gold's record high prices highlight the importance of having a clear and strategic approach to investing in this valuable asset. Gold can serve as an excellent hedge against inflation and economic uncertainty. But as with any investment, it's essential to choose the method that best aligns with your goals and risk tolerance. Whether you decide to invest in physical gold, ETFs, mining stocks, or more sophisticated instruments like futures, diversification remains key to protecting and growing your wealth. Remember, investing in gold isn't a one-size-fits-all decision. It requires understanding your unique needs and preferences. If you found this video helpful, don't forget to give it a thumbs up, subscribe to the channel, and turn on notifications to stay updated on all my future content. I'd love to hear from you in the comments. Have you already invested in gold? And if so, what's your preferred strategy? Let's get a discussion going and share our thoughts on how to navigate these uncertain times with smart investments. Thanks for watching, and I'll see you in the next video where we'll continue exploring ways to protect and grow your capital. Until then, invest wisely and stay informed. See you next time.